For the past few years, it's kind of felt like the rules of investing were pretty simple. But according to BlackRock's 2026 outlook, that game is officially over. A really fundamental shift is underway, and if you want to stay ahead of it, you have to understand what's changing. So let's dive in.
And this quote from Rick Rieder, it just nails the new reality. I mean, if you felt like investing has been almost too easy lately, where it seemed like every bet paid off, you weren't wrong. But that's all changing. The house edge is back, and that means our strategy has to evolve from just gambling to real, actual investing. So, okay, this is the big idea we're going to unpack. We are moving from what we'll call the casino market of the early 2020s, where just about any risk you took was rewarded, to an investor's market. And that's a market that demands a much more thoughtful, much more selective approach. So why is this shift happening, and what does it actually mean for you? All right, so first up, why is the casino closing down? Let's unpack why the old playbook is basically obsolete now. That whole era of easy, widespread market gains, where a rising tide lifted pretty much all the boats, yeah, that's officially behind us. And I mean, just look at the numbers here, they really tell the story. Between 2020 and 2024, an incredible 90% of S&P 500 companies delivered positive returns. You could have practically thrown a dart at a list of stocks and won, but in 2025, that number plummeted to 60%. That means a full 40% of the market is now in the red. The game has already changed, folks. Okay, so as the market changes, the whole economic narrative is changing too. The story that everyone has been obsessed with for years, inflation, is being replaced by a new and honestly more complex story that's all about the labor market. And look, the good news is that the inflation storm really seems to have passed. Markets are now pricing in inflation at around 2.3% for the next 5 years, which is pretty much a perfect number for policymakers. So, in short, the Fed's main battle, it seems to have largely been won.
Which of course leads to the big question, right? If we're not fighting inflation anymore, where should we be focusing our attention? What's the new pothole in the road that we need to watch out for?
Well, the answer, and this might surprise you, lies in the labor market. Now, while the headline job numbers might seem okay, if you strip out the healthcare sector, the rest of the U.S. economy has actually stopped creating new jobs. For the first time in over 25 years, outside of a recession, this average has turned negative. That is a quiet but absolutely massive shift. And when you start digging a little deeper, the warning signs just get clearer. The unemployment rate is climbing up. A huge chunk of recent layoffs, we're talking 70%, are because of efficiency, not just a temporary downturn. You add in slowing wages and record low confidence from households about the job market, and suddenly that economic foundation is looking a whole lot shakier.
And that word right there, efficiency, that is the perfect segue to the single biggest force behind this entire restructuring, artificial intelligence. But we need to stop thinking about this as just a tech story. No, this is a cost revolution that is fundamentally changing how businesses operate.
According to BlackRock, AI's biggest impact right now isn't about creating flashy new products. It's about efficiency. It's a powerful tool being used to reduce headcount, to automate tasks, and to boost productivity. Essentially, it's rewriting the entire cost side of the corporate ledger. Now, the scale of this change, it's almost hard to wrap your head around. We're talking about a potential $1.2 trillion in annual labor cost savings just from using these new technologies. Let that sink in for a second. That is a staggering amount of money being reallocated within the economy every single year.
And if you project that out over the long term, the potential prize for corporations is a mind-boggling $82 trillion. Just to put that into perspective, that's more than 3 times the size of the entire U.S. economy. This isn't a minor tweak, this is a massive structural transfer of value.
So what does all this mean for investors? How does this translate to the bottom line? Well, the analysis suggests that just a 9% reduction in labor costs, which is made possible by AI, could lead directly to a 31% boost in corporate earnings. That is the incredible power of this cost revolution.
Okay, so given this new reality, a slowing labor market on one hand and an AI-driven cost revolution on the other, how should you invest? Let's get into the new playbook for this investor's market. BlackRock boils it all down to 4 key pillars. It starts with a solid foundation of quality income. Then you get selective with some of the higher risk assets, you diversify globally, and, this is the big one, you focus on owning the specific winners of the AI transformation. So for the income part of your portfolio, the idea is to be smart about it. Investment-grade bonds from really financially strong companies can lock in the high yields we're seeing today. Things like mortgages, stuff that's backed by physical collateral, that can add some extra yield with built-in protection. And really importantly, debt from emerging markets offers a crucial way to diversify away from purely US-based risks.
And then when it comes to stocks, this is huge. The new rule is selectivity. It is no longer about just owning the entire market and hoping it all goes up together. It's about finding the specific businesses that are successfully using AI to actually improve their profit margins and strengthen their competitive advantages for the long haul.
And this all brings us full circle. Right back to our central theme, we are moving out of the casino and into a market that rewards a completely different mindset. And this quote just captures the new paradigm perfectly. Success in 2026 and beyond isn't going to come from chasing hot trends. It's going to come from careful selection, from the patience to let your income compound, and from the discipline to focus on quality businesses that are on the right side of these major economic shifts. So, we'll leave you with this final thought. The environment is different. The odds that worked for the last few years are officially off the table. The only question left is, has your investment strategy changed with them?